morning and happy Sunday. I'm John Kosar, Chief Market Strategist at Asbury Research. Thanks for viewing our latest Following the Money podcast. Today's date is Sunday, October 6th, 2024. Today I'll be talking about what Asbury Research's latest data-driven market research and quantitative models are saying about the latest financial market conditions. Specifically, should we be on offense right now and looking for opportunities, or should we be playing defense and protecting our capital? What makes Asbury Research different from other research and asset management firms is that we are completely data-driven. We're not trying to predict what the Fed might do or who's going to win the election and what that's going to mean financial markets going forward, or forecast where the S&P 500 is going to close at the end of the year on New Year's Eve. We think a lot of this is more show business than it is the investment business. The fact that nobody knows any of this stuff ahead of time, and nobody especially doesn't know however these events turn out, how they're going to affect financial market direction, keeps us just focused on the money, focused on following the money around, focusing on the data, because the data never lies. It isn't opinion. It isn't somebody trying to figure everything out. We're just strictly watching the money. Effectively, what we're doing is we're watching the money as it rolls around the financial space because it's truth. And generally speaking, where the money goes is where you're going to get the appreciation and value. The movement of money is what really drives prices. Of course, there's other inputs, but really the movement of money, in our view, is the main factor, and it's the most sensitive indicator of the changes in market opinion by investors collectively that ultimately change the market's direction. Asbury Research is a registered investment advisor and has been providing investment research and asset management to individual and professional investors since 2005. So this is our 20th year. To get more information about us, visit asburyresearch.com and click the contact tab. You do that by going to About, hovering over About, going down to Contact, or you can just click the link down underneath in the description of this video. Finally, if these YouTube videos are useful to you, please like and subscribe. A couple of quick announcements before we get to looking at some of our latest research. Number one, we now have a Substack newsletter. There is a free version that you can sign up for at asburyresearch.substack.com. This is for those who like the Following the Money podcast and want to see more of our research, more of our ideas. Go to Substack, asburyresearch.substack.com, and you can sign up for the free version. There's also a paid version there as well. It includes selected charts from our premium research service, which we're going to get to in just a second. Finally, or secondly, I should say, second thing that's new is we have recently combined our own models, including the correction protection model, CPM, and our CEF model to create 4 different model portfolios. We've got the Asbury Aggressive Portfolio, Asbury Balanced Portfolio, Asbury Conservative Portfolio, and the Asbury Ultra Conservative Portfolio. These models can be implemented into your trading account, into your portfolio by yourself. You can do it yourself. If you have a subscription to our premium research service, will show you the models and the increments of each of those so you can emulate these different portfolios. Or we are an RIA and we can trade these portfolios for you within your own investment account or within your client's portfolios if you're a portfolio manager. These Asbury Research models and portfolios were created by extensive quantitative backtesting of various combinations of standard and proprietary indicators that measure a broad scope of data-driven market conditions, including we look at asset flows, market volatility, standard deviation, and relative performance, and more. Based on my doing this for 40 years and my understanding of what really matters and what really works in the financial markets. However, Past performance is indicated from historical backtesting is hypothetical in nature and does not involve actual client portfolios. It doesn't consider cash flows or extraneous market events and is not predictive of future performance. Please read carefully the disclosures and disclaimers which will run at the end of this video. Let's take a closer look at one of these four model portfolios, the Asbury Aggressive portfolio. So I'm going to jump views on you here. And here's the Asbury Aggressive portfolio. I'm going to breeze through this. If you'd like a copy of this PDF, you could go to the contact tab and you could ask for it. There's a little text box there. Just say, please send the PDFs for the portfolios, for the Asbury portfolios, and we will send you those. Or if there's one particular one, we'll send that. So we're just going to go through this kind of cursory and show you what we've done. We've taken three of our models, our CEIF model, our CPM model, and our CPM Ultra model, which is one of our newer models, combined them together to come up with an aggressive way to trade the markets following our own ideas, following our own creations. This is cumulative 5-year performance, going back 5 years since the end of 2019. And you can see over the past 5 years, the S&P 500 has had an annualized return of 13.4%. That's the blue line and the blue column. And Asbury Aggressive has been 23.5 over the past 5 years. Looking in 3 years, it's been at 14.7. Looking back 1 year, 22.5, and so on. And you can see the chart here. Green is Asbury Aggressive, and the blue is the S&P 500. This is looking back 3 years. This is a quarterly performance over the past 3 years. And the part that's the most important to me, that's most important to us, here's the 1 year. So you can see over the past year, it's basically been a relative performer versus the S&P 500. But the most important thing to me is I want to see what the risk metrics look like. And here's standard deviation going back 5 years. This is as of September 4th. So it's a couple of weeks old. It's about a month old. But you can see that the standard deviation for the S&P 500 was 18.2. It was 18.3 for the portfolio, Asbury Aggressive portfolio. So virtually identical. If you don't know what any of these terms are, go to Investopedia.com. We don't have any affiliation with them other than it's a great online glossary of financial terms. So any of these terms or jargon that I'm going to use here that you don't understand it, you can find it in Investopedia.com. Looking at beta, which is another way to measure risk. Over the past 5 years, Asbury Aggressive has been 0.92 versus 1.0 for the S&P, so about the same. This one down here, the maximum drawdown for the S&P 500 during the past 5 years was 33.9%. That was during COVID. This portfolio maximum drawdown was only 21.7%. So basically 22% for this Asbury Aggressive portfolio versus 34% for the S&P 500. And finally, the Sharpe ratio, which is one of a number of different mathematical representations of risk versus reward. Our Sharpe ratio for the past 5 years was 1.18 for this portfolio versus 0.69 for the S&P 500. So that's how these models work. Again, if you want further information on these, feel free to contact us via the contact tab, or you can call us during business hours, 888-960-0005. Now, let's follow the money by identifying our key areas of focus as we look towards the end of the year. We're going to begin by looking at the Asbury 6. Most of you are familiar with the Asbury 6 from the appearances that I have done in the media. It's a pretty popular tool that I think a lot of people have gotten to know. So we're going to go there next. So we're going back so we're going to go to the research center now. This is password protected at asburyresearch.com. And we're going to scroll down. Here's all of our models. You see the correction protection model here, our CEF model, our ETF ideas, and so on. We're going to Asbury 6. We're going to have a look at that. This is updated through the end of last week. The Asbury 6, for those who don't know, is our daily updated risk management model that looks beyond the day-to-day volatility and noise of the stock market to determine its actual health. We view the Asbury 6 as a lie detector test for the market, a quantitative lie detector test for the market that helps investors identify real sustainable market advances or market declines from these computer-driven traps for investors that we seemingly see once a week, where the market's up 50 in the morning and it's down 50 by lunchtime. Very, very difficult sometimes to retain your position in the market with all this gyrating going on. So I built this internally for me to keep me from biting on these false moves. And over the years, we've put it out to our subscribers. According to historical backtesting, for those who wonder, okay, what does this do exactly? The Asbury 6 has kept right up with the S&P 500 since the fourth quarter of 2017 at about a 12.4% annualized return. But the difference is the maximum drawdown in the A6 has been 13.6% compared to that 33.9% drawdown during COVID for the S&P 500 that I mentioned a few minutes ago. What's the downside? It's active. This is an active metric. The Asbury 6, for it to turn red or negative from here, 4 or more of these constituents would have to turn red. Going back to the fourth quarter of 2017, the Asbury 6 has had about 11 round turns a year. Round turn means from going from green to red, going from 4 green to 4 red, which would be one cycle of bullish to bearish. So it is active, but it does a very good job of limiting the downside if you don't mind all of the activity. So that's the Asbury 6 heading into next week. We are still positive. We've been positive in the Asbury 6, 4 or more green since September the 12th. The S&P has risen by about 3% since then. Now we're going to look at sector rotation via our CEF model. So we're going to change views again. We're going to go right here and we're going to go to a slideshow. This is part of our CEF model that subscribers would get if you were a subscriber to our service. This is one of the components of the CEF model. So the data is through the end of last week. How to interpret, I'm not going to read this for time considerations, but basically we built a model that follows the money around the 11 sectors of the S&P 500, and we've assigned values to them. Here are the values heading into next week. This is the model heading into next week. It is the 3 top sectors are the utility sector, the energy sector, which is brand new in that spot. It has been down at the bottom for quite some time, and the communication services sector, XLC. The way that the model works is we're always invested in the top 3 sectors. When the rebalance takes place over the weekend, if there are any changes, they take place on the opening the following Monday, which is going to be tomorrow morning. And so we basically are always invested in those sectors. It's a completely data-driven sector rotation model. The acronym for CEF is Sector ETF Asset Flows. We built the model to quantitatively identify long overweight opportunities in U.S. market sectors by, again, following the money as it moves around the board. Those 11 sectors together are the S&P 500. The CEF model is always fully invested in the market, uptrend or downtrend alike. Provides investors, me, for my own account, full disclosure, I trade these models for myself. The CEF model provides us with a dynamic alternative to the traditional buy and hold portion of a portfolio. Many investors, myself included, I don't like to be 100% in cash. Most money managers can't be 100% in cash. So rather than sequestering a portion of your portfolio that's buy and hold, you always keep it in the S&P 500. For me, That part of my portfolio is in the SEAF model. And as the money moves around the various sectors, I'm always invested in the three which, according to our model, are getting the most love from investors. You can learn more about all of our models, including charts and back-tested hypothetical performance tables, by visiting asburyresearch.com. We'll blink over there real quick. Let's go back here just for a moment. Going to asburyresearch.com, going to models, and you can scroll down to the SEAF model and you can get more information about how these models work and how we use them inside of our portfolios. Let's get back to our slideshow here real quick. So let's move to some of these charts that are the accompanying charts. This is a new feature, by the way, for our premium service. Once a week, we update all of these specialized charts. These are our own creation. We call them rainbow charts for obvious reasons. And this is 1 year look back on the model, the rankings, looking back 1 year. This is financials, XLF, and favored is green, and neutral is yellow, and avoid is red. The takeaway here is when a sector moves in the favored ranking according to the SEAF model, it usually accompanies outperformance. Note here, back in right around the 4th of July, when financials moved into a favored status, look what happened to the relative performance chart. This is relative performance down in the bottom panel of XLF versus SPY. Look at all this outperformance we had from here to here. Once we dove back into neutral, we started to lose that relative outperformance. Now we're slowly starting to move into a void, which tells us this is not a place that we want to be right now. Let's look at just a couple more of these. Let's go to energy. So energy has been bouncing in and out of a void since May of this year. And look at all the relative underperformance by XLE versus SPY. We shot into favored territory here. We don't know if it's going to last for 2 weeks or if it's going to last for 2 months. When it lasts for 2 months, like it did back here in February and March, we got some nice relative outperformance by XLE. But as soon as we lost that, we lost the trend, and XLE's been underperforming ever since. So this has worked its way into the top 3 based on this favored ranking. As long as it stays there, we're going to stay there with the money, and ideally we're going to catch another nice period of relative outperformance. We're not trying to predict anything. We're following the money. Let's look at a couple more. Let's look at utilities. Utilities it moved back into favored status from neutral back at the end of July. Look at all this relative outperformance we've captured by utilities. As long as we stay favored according to the model, then we're going to remain in utilities. Let's look at one more if we can. Let's look at let's go communication services. Communication services is moving back into favored territory. If it stays there for an extended period of time, we're likely to get some relative outperformance like we did here in June, and like we did even better going all the way back here to December of last year. We had this extended stay favored according to SEAF, and we got all this relative outperformance. So again, this is a new feature. All 11 of these are updated for our subscribers, our premium subscribers, and that's how this works. The last thing I'm going to show you, this is going a little bit long, but the last thing that we're going to take a look at today is we're going to look at a couple of charts from our premium service. We're going to go to our keys to this week. Keys to this week is, as the name suggests, a weekly report. Jack and I probably look at 150 charts, and we pick 10 that we think are the most important to upcoming market direction. And the four we're going to look at today are, we're going to look at the support and the resistance levels in the S&P 500. 5670 to 5652, as you can see here, are the highs that we made back in July and August. If we break through as long as we hold the support, the market is going to be technically healthy. It's holding the support level. If we break through here, that means the market's had a little hiccup, and we're probably going to have some kind of a minor correction lower. Where could it go to? 55.47 is the 50-day moving average. It's a minor trend proxy. That would be the level we would be looking at if 56.70, 56.52 is unable to hold over the next week or two. The next thing we're going to look at is a chart that we looked at when I was with you last 2 weeks ago, and we looked at an emerging breakout in the NASDAQ Composite Index. This is the larger, the broader of the two NASDAQs. It encompasses more stocks. The market has been drifting, or the comp has been drifting sideways since July, forming kind of a cone pattern. It's called the triangle pattern. We broke out of that pattern on September the 19th. That suggests that this larger move higher is starting to re-engage. As long as we stay up above 17,395, the target's a move to 20,250. That's about 12% higher than the comp is trading at right now. The comp technology more broadly tends to lead the broad market up and down. So this is a key focus of ours going forward. Another focus of ours is Microsoft. Microsoft has been sitting on a major support level since August. It's the 200-day moving average, which is a major trend proxy that I don't think you can turn CNBC on for more than 10 minutes and not have somebody mention. It's sitting on that support. It's been riding it since August the 5th. As long as we hold it, we're in good shape. If we start drifting underneath it, Microsoft is second largest stock according to market cap, and it has a lot of sway in the overall market. So we're focusing on Microsoft next week to try to let us know if we're going to begin a new leg higher here that's going to go up and touch our target in the comp, or if the market just ran out of gas here and we're going to take a little bit of a rest. Finally, NVIDIA. Note that we've got investor indecision going on in NVIDIA since June. Look at this well-defined coil that keeps shrinking and shrinking. The market is getting more and more tentative about trading up into new highs or trading into fresh highs. We need to get above 125.35 and stay there in order to indicate that this bigger move higher that started last year is going to re-engage. On the contrary, if NVIDIA breaks down through the lower part of this investor indecision, that's a big problem. So finally, let's just take a fast look. I'm going to go back here. We're going to take a fast look at next week's economic calendar because those are the speed bumps you need to be aware of. Wednesday, October the 9th, minutes of the September FOMC meeting and a lot of Fed speak prior to that. So it's Fed day, a lot of Fed chatter, and then finally they're going to release the minutes early afternoon in New York time. On Thursday, 10/10, September CPI. It's the Consumer Price Index. It has to do with inflation, which is a hot topic right now. Finally, Friday, October the 11th, is going to be September PPI, which is the Producer Price Index. So the Fed and inflation is a big focus in the middle to the end of next week. So this was a long one. Hope I didn't keep it too long. That's going to wrap up Asbury Research Following the Money this week. Our next Following the Money podcast is tentatively scheduled for Sunday, November the 3rd, 2 weeks from today. If you like our approach to investing, we can help you with either data-driven research or money management that implements my 40-plus years of experience on the trading floor and as a money manager and as a research analyst. Again, you can request more information about us by going to Asbury Research, going to About, and clicking on the Contact tab and giving us your information. Hope to see you again here soon. And please don't forget to link and subscribe. Go Chicago Bears. Kickoff at noon today. We'll see you in 2 weeks.